Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Greetings, welcome to the show. Thanks so much for joining us today. Today we talk about delayed onset investment glide paths in college savings and retirement plans. That's a mouthful. I promise we'll make it digestible. All right, so let's get right to it. Delaying the start of the decrease in the percentage invested in stocks in an age-based asset allocation, enrollment date and target date funds can increase the investment returns without significantly increasing the risk of investment loss. Okay, so first of all, we have to just go ahead and say investment risk is unavoidable. The risk of a stock market downturn is really unavoidable when you're saving long-term for a child's college education or for your own retirement. During any 17-year period, the stock market suffers at least 3 corrections and at least 1 bear market. A correction is a decline of 10% or more. A bear market is a decline of 20% or more. During any 45-year period, the stock market suffers at least 10 corrections and at least 4 bear markets. That's a ton, but you can manage investment risk by using a dynamic investment strategy that kind of adjusts the asset allocation over time. What is an asset allocation anyway? An asset allocation balances investment risk and investment return by specifying a mix of investment classes which offer different risk and return profiles. Aggressive investments include high-risk, high-return investments like stocks. Conservative investments are those low-risk, low-return like bonds, CDs, money market funds, and of course cash. The asset allocation specifies particular percentages of aggressive and conservative investments. All right, so as some investments appreciate in value, it might be necessary to rebalance the portfolio periodically to maintain the target asset allocation. Rebalancing just involves selling some investment classes and buying others. Most of an investment portfolio's long-term return on investment is attributable to the asset allocation as opposed to the actual investments themselves. What is a dynamic investment strategy? Let's talk about that. So a dynamic investment strategy changes the asset allocation periodically. One type of dynamic strategy shifts from an aggressive mix of investments to a more conservative mix of investments. This is in contrast with a static investment strategy, which really doesn't change the asset allocation. The pattern of changes in the asset allocation over time is called an investment glide path. This is all coming together. Both dynamic and state investment strategies rebalance the portfolio periodically. A dynamic strategy may rebalance the portfolio a little more frequently to match changes in the asset allocation. Investors can use a more aggressive asset allocation right up front in the beginning of a dynamic investment strategy, just because less money has been saved and there's just more time to recover from investment losses. As the goal approaches, the portfolio is then shifted to a more conservative mix of investments to lock in the gains and reduce the risk of investment losses. Okay, now we move on to talking about delayed onset investment glide path. Investment glide paths move off of a high percentage invested in stocks and other high-risk, high-return investments too quickly. All current dynamic investment strategies for college savings and retirement plans start reducing the percentage invested in stocks immediately and continue to decrease this percentage monotonically. Delaying the onset of reductions in the percentage invested in stocks by a number of years can increase the overall return on investment without significantly affecting investment risk. I hope you're staying with me here, but the duration of the initial investment in high-risk, high-return asset classes is increased and the investment glide path is then compressed to fit the remaining investment time horizon. I invented age-based asset allocation in the early to mid-1990s, but actually didn't patent it at that time. The idea was rapidly adopted by all 529 college savings plans. Now, I've patented a big improvement in age-based asset allocation and similar dynamic investment strategies. So let's move on to dynamic asset allocation for college savings plans. All college savings plans offer at least one age-based or enrollment date investment option. An age-based investment glide path changes the allocation based on the age of the beneficiary. An enrollment date investment glide path changes the asset allocation based on the number of years remaining until college enrollment, similar to target date funds for retirement. Typically, an age-based asset allocation moves the funds from one portfolio to another, and an enrollment date asset allocation changes the asset allocation within a single investment portfolio. About half of dynamic investment glide paths start out at 80% equities, and about half end up with 10% equities. The most common pairs of starting and ending percentages involve 100% to 30% high risk, 80% to 20% medium, and 60 to 10% low risk. More than 2/3 of investors in 529s are invested in age-based or enrollment date investment glide paths. Delaying the onset of a shift to a more conservative mix of investments by up to 10 years increases the annualized return on investment by up to a full percentage point without significantly increasing the overall risk of investment loss. This is huge. The investment risk grows significantly if the onset of the age-based allocation is delayed by 11 or more years. Dynamic asset allocation now for retirement plans. Target date funds, sometimes called life cycle funds, you may have heard that term, just kind of aim to gradually reach a particular asset allocation by a specific year. But a common rule of thumb sets the percentage invested in stocks to 100 minus your age. So, a 20-year-old would invest in 80% stocks, while a 65-year-old would invest 35% in stocks. This is an example of a linear investment glide path that immediately decreases the percentage invested in stocks. Assuming a 45-year investment horizon, delaying the onset of a shift to a more conservative mix of investments by up to 30 years increases the annualized return on investment by up to 1.4 percentage points without significantly increasing the overall risk of investment loss. After 30 years, the investment risk starts to increase significantly. So if you save $250 per month, for example, this approach can increase retirement savings by more than $200,000. And by the way, this approach also smooths out volatility. That is our show for today. Kind of a quick hitter, but a lot of information in there. If you want to dive a little bit deeper on this, please go to thecollegeinvestor.com. Just simply copy and paste the title of this podcast right into the search bar and you'll see it. Thanks again for stopping by today, and we'll talk to you again real soon.